Dear students and viewers, I welcome you with another exam style question on the subject of business mathematics. This question will test your knowledge and make you learn the concept of an investment decision based on its net present value or NPV. Zenith School of Accountancy is committed to providing free learning to students from all walks of life. To watch other exam style videos, please explore my channel's playlist. Please also subscribe to my channel to stay informed about new videos. So today's question in this series is about business mathematics concepts. The question is, Sarah is considering three options, only one of which she can afford. All three have the same initial outlay, but there are different income patterns available from each investment. Investment A pays $2,000 each year at the end of the next 5 years. Investment B pays $1,000 at the end of the first year, $1,500 at the end of the second year, and so on until the final payment of $3,000 at the end of the fifth year. Investment C pays $4,000 at the end of the first year, $3,000 at the end of the second year, and $2,000 at the end of the third year. Sarah estimates a constant rate of interest of 10% throughout the next 5 years. Based on this information, which investment should Sarah choose? Investment A, investment B, or investment C? We need to remember that since all the three investments have the same initial outlay, therefore the best investment will be the one with the highest net present value. First, we calculate the NPV of the inflows of investment A that has a constant annual inflow of $2,000 for 5 years. There are two ways to calculate the NPV with constant inflows. In the first method, that is laborious, we will calculate present value of each year separately and then add up the PVs of all the 5 years as it is shown in the table. The PV factor for each year is calculated by applying the formula, that is present value is equal to 1 divided by within bracket 1 plus R to the raised power n. This is the formula of the discounting. In this formula, n is the number of year and R is the discount factor expressed as a decimal point. For year 1, n is 1 while R is 0.10, that is 10%. Similarly, for year 2, N is 2 and R is again 0.10 and so on. The present value for each year is calculated by multiplying the present value factor value with the inflow of that year. For example, for year 1, the PV factor is 0.909 and the inflow is $2,000. The multiplication will give us a PV of $1,818. When we add up the PV of 5 years, we get NPV of $7,580 for investment A. The second method to calculate the NPV with constant inflows is by using the cumulative discount factor tables, also called the annuity tables. From tables, the cumulative present value factor for a constant inflow at 10% for 5 years is 3.791. Hence, the NPV of investment A is $2,000 multiplied by 3.791, and this will give us a value of $7,582. You will notice a small difference of $2 due to rounding error in our table in the previous method. Similarly, we can calculate the NPV of investment B as shown in this table. In this case, the NPV of investment B is $7,220.50. Finally, we calculate the NPV of investment C as shown in this table. This gives us a value of $7,616. In summary, the NPVs of investment A, B, and C are $7,582, $7,220.50, and $7,616 respectively. As the outlay for each is the same, the investor should choose investment C with the highest NPV. If you have enjoyed this video, please do subscribe to my channel, click the bell icon for notifications, and also share and like this video. Thank you for watching.